Welcome everyone to another edition of the Tony Sirianni podcast. I am thrilled to have our friend Robert Stark, who's the CEO of Nomura Capital Management, with us today. How you doing, Robert?
I'm great. Thank you, Tony. Thanks for having me. Great to
Well,
see you.
happy you're here. So help everybody out. Just big picture. Nomura versus Nomura Capital USA. I think everyone's familiar with the idea that there's a Nomura in Japan.
That is a good start. Starting in Japan. In fact, the firm was started this year 100 years ago,
Okay,
and we
ready?
started in Japan in wealth management, actually. So something that all your clients are very familiar with. We are today still one of the largest wealth management firms in Japan. That's kind of our bread and butter, how we were founded around 100 years ago. Probably makes up still 30% or so of our revenues. The second business that we have is what we call wholesale banking. So that's the combination of investment banking activities as well as sales and trading. It's truly global business. That's around 60% of our revenues. And then last but certainly not least, it's asset management, which for us globally is around 600 billion in assets under management, of which 40 billion are managed here in the US. And we've put that all under one brand, which we call Nomura Capital Management. And that is a combination of both public and private credit activities serving both intermediary clients such as RIAs, as well as institutional clients such as pension funds, endowments, foundations, and insurance companies.
So I'm pretty good at this. I can tell by your accent. I'm thinking Chicago. You're from the east side of Chicago. So I
You
just
wish.
wondered how a guy from Chicago, got to run a Japanese bank in America. What
Yeah.
journey?
Believe it or not, my kids are making fun of my accent as well at this point. I was born in Germany to an Austrian father whose whole family came from Austria and Eastern Europe. There he was from the Steiermark, which is where Arnold Schwarzenegger is from as well,
Ah,
who
this
was
is
very successful in keeping his accent. I'm actually wondering whether I should put more focus on my German accent, but I'm trying to hide it very unsuccessfully. So my mother's actually was from Colombia. So she was born in Colombia. That goes back to the dark days or the dark ages of the German history that we all wish never happened. So her parents were German Jewish and escaped Germany in the early 30s.
good for
So
them.
they were smart enough to leave early. But when my great grandmother was a widow and my mom was 10 years old, my great grandmother first and foremost wanted to uh, come home, and so that was Germany first and foremost. And so she took my mom with her, and here I am.
Oh wow, okay. Well, so now that you're in America, what advantages do you see in the American market for Nomura? Like what makes this such a good place to be?
Yeah, so I mean, needless to say that the US is the largest asset management market globally by a long shot. And it's not only the largest in size, the growth rates are very attractive as well. Um, on top of which, it does help if you have a single market with 300, call it 30 million of citizens, one language for the most part, one tax system, um, one regulatory environment,
Yeah.
et cetera, et cetera. So you don't find this anywhere else in markets that one would aspire to be in. So if you take most of Asia, it's all over the place, different languages, different regulatory system, and you have to pay for Europe. So there's many benefits in addition to the fact that it's not only one of the largest or the largest market, it's also one of the fastest growing markets.
I know, one of the things that you guys are doing, you have private credit, and that's something that's interesting for me with advisors, right? Because they're not, a lot of advisors typically are not associated with a large firm that would have its own private credit stuff. So, and I know you guys do that. So and I know there's demand for it just based on where, all right, what do you see as driving that demand? Or maybe we should talk about what is the private credit product from your point of view.
Yeah, sure. So first and foremost, the one of the most significant shifts we see in the investment world have been a shift to lower cost vehicles. So that's not only active to passive, mutual funds to ETFs. It's across the board everywhere. So cheaper ways to allocate. That's number one. Number two is a shift from the public markets into the private markets. And number three is increased regulatory pressure, especially for banks.
Yeah.
So if you add these three things up, you immediately get into the private credit world because banks are continue to retrench from lending activities. And financial advisors and their clients have historically not have many opportunities to invest in private credit. So unlike, so BDCs were an early form of that, but that was all direct lending related. So I think when most people talk about private credit today, what they actually mean is direct lending. And we here at Nomura feel that private credit is so much more than just direct lending, especially if you think about real estate lending, asset-based lending, and especially finance. So those markets make direct lending look like very, very small.
How can an advisor, with the advantage of them, how can an RIA sitting out there, how can they take advantage of that?
Yeah.
The opportunity that you clearly see here.
So advisors, first and foremost, advisors should focus on what's the risk return that they want to generate for their clients, what's the risk tolerance of their clients and the risk capacity, not only the risk tolerance at any given point in time, but what do you do if there's a sell-off? What does the client want to do? So that's the most important thing. So which therefore I would argue semi-liquid structures are actually very suitable for advisors because they kind of protect advisors and their clients from sell at the wrong time. So just because there is a dip in the market, that doesn't mean you should sell out of it because typically that recovers. In the private markets, you also have a delay of those activities. So semi-liquid structures protect you from sort of those activities. And
are these mostly non-correlated to equities in your mind, or
absolutely,
correlate? Yeah, okay, all right. So
absolutely.
you're buying non-correlated assets with an idea almost to hedge what you're.
Yeah, I would think about it as you're enhancing the risk return profile of your client's portfolio. So if you think traditional 60-40, let's say, a lot of that has shifted to my earlier point into lower cost vehicles, whether that's index funds or ETFs for that matter. For larger clients, it's a simple SMA in that regard. But how do you actually fit in less correlated, more diversified asset classes, whether it's private equity, real estate, infrastructure, or private credit for that matter? So what we see where it potentially adds significant benefits to end clients is private credit offers diversification. If it offers income, so a steady income stream, and it offers a lot less correlation to the public markets for that matter. And then the last piece I would add, especially around diversification, it's not only diversification to public markets, but also within private credit. If you not only allocate to direct lending, but also include other sectors within private credit, such as real estate lending, asset-based lending, especially finance, you really get a lot of diversification, less correlation and income into anyone's portfolio.
Yeah. And you guys also do, there's asset-based lending fits in here somewhere. So which is a big deal because, advisors are always, a lot of the folks who moved into the RIA world came from big banks,
Yep.
but there was the opportunity to do that. And then, again, like we talked about with private credit stuff in general, where are they going to get it? How do they get access to it?
Yeah. So asset-based lending is a fairly broad sector. You couldn't even put real estate in it because at the end of the day, asset-based lending provides financing secured by tangible cash flowing assets. So essentially giving lenders direct claims to valuable collateral, right? So in the structure offers enhanced protection in the event of a default. And that's a critical feature in today's market environment and can be anything, any sector, and can be small business loans, can be consumer credit, can be real estate. So this can be factoring, revenue streams, machinery, equipment. So it's a very, very large sort of pool of potential assets. And so the value really is in the collateral at the end of the day, and the fact that you have cash flowing assets. And that we think provides a huge opportunity, especially for RAs in that regard, and having access to that. We have, in our dialogue with RAs, most sort of are more familiar with direct lending, but when it
Yeah.
comes to other asset classes, a lot less so. And that's essentially why we have created the investment strategies that we've made available.
So let's talk a little bit about, because we talked about the RIAs that need it, and we get that the business has shifted and they need support out in the RIA world. And your average RIA managing 100, $150 million, right? But there are some that manage 500, multiple billions that we know of. What's the client look like in your mind? So
Yeah.
if I'm an advisor looking at my book, who's this good for, and who should I maybe steer away from, or it's just they don't have the asset base to make it worthwhile.
Yeah. So it depends a little bit on sort of the underlying strategy and structure.
Yeah.
So if it's, for example, an interval fund that is much more geared for what, like, call it the accredited investor. Although I would extend the definition a little bit, I would say anyone that has between, call it $500,000 all the way to five, if not even $10 million, should look into that. Because even if you have $5 million, you're not going to put like 30% or 20% even of your portfolio in structures that have lock-up periods of like up to 8 years.
Yeah.
That sort of, even for someone that has 5 million, that's probably not the right thing to do. So semi-liquid structures such as interval funds actually are a nice blend, because while I wouldn't consider them a liquid instrument, they definitely offer more liquidity than an 8-year locked up period. And so that to me is a very good structure to take a look at. We have created an interval fund, which is called the Nomura Alternative Income Fund, NAIFX. And the whole idea here is to provide accredited investors access to the whole private credit world in a very diversified way. So you actually do get access across the entire private credit spectrum, asset-based lending, real estate lending, especially finance, as well as direct lending. And the advisor doesn't have to worry about when to go in and out and how to allocate amongst those sectors. We do it all for them. So it provides the opportunity for diversification away from public markets as well as from within private credit.
So my contention has been that AI is going to drive the use of alternative products in general, because AI is going to soon be able to be pretty good at telling you you need to buy these ETFs, or as you mentioned, when you talk about equities going to ETFs and the general index funds. I mean that's just a check on a box. I mean you can go to Fidelity and you can go anywhere and do it. But the private markets, AI can't look into. So you really can distinguish yourself as an advisor and advantage a client by giving them stuff in the private markets.
That's exactly right. I mean, this is, if we remember what we talked about, the three trends, like one of which is the shift from public to private. And I would hope, though, that AI over time can even help there, quite frankly. But there's one thing that we haven't talked about, and that's like, if you think about what is required that more RAs and their clients start allocating to private credit and other private sectors, it's education. Really making sure that advisors fully understand these spaces. And that's, quite frankly, that's what we do in virtually all of our meetings. A big component is educating clients around what is private credit, why is this relevant, why should you be thinking about this, how should you think about embedding this in anyone's
So
portfolio. This is really
who,
important.
who's doing that with you guys? You guys doing it with white papers? One-on-ones with at firms? How does that happen?
Yeah, so it's a combination of things. So we do this
And
in
by the way,
every.
one of the struggles is RIAs. You used to be able to go to Merrill Lynch and buy pizza for 50 or 100 guys, and now people are spread out all over the city in a whole bunch of different places. So it's a challenge to
Yeah.
sort of get the message out there.
Yeah, I personally, I actually think the RA model aligns itself best from a fiduciary perspective with what we do. At the end of the day, we are an RA as well. So our clients are RAs, we are an RA. So from a fiduciary perspective, we both have the same in common, and that is serving in the best interest of the client. And so but it starts with every single dialogue is centered around making sure that we educate our clients and prospects around what private credit even is. So
Yeah.
that's one. And you not only you do that conversationally, you mentioned white papers. We've develop various white papers, whether it be on an introduction to private credit, whether it's sort of a deep dive on asset-based lending, for example. That's another piece. So and then we try to invite advisors to sort of due diligence meetings where they get to know the portfolio management team, but we can also talk about markets, educate RAs on that, on our views on private credit. So it comes from a whole variety of things that in the grander scheme of things, you can all label this education. I cannot emphasize enough on how relevant that actually is.
And by the way, advisors take that information, educate their clients, and that's when they do the best job, is when they can be you're certainly the best salesman when you can educate and teach,
Well, we have to do it in a way that if we can't explain it to the advisor in a simple way, the advisor is never going to talk to its clients about this. And
No,
so
and they probably shouldn't, because once you get into a very complicated product that you can't explain to your client in a few minutes and make them understand, you probably should get something else.
fully agree.
Yeah. So, all right. So, what's next? Where do you see this going? Where do you see, not just Nomura, but sort of the marketplace for this stuff and what you guys are going to do?
Yeah, look, here in the US, we manage around 40 billion across all our investment teams. So we have a high yield team, which actually was a startup within Nomura 34 years ago. And now it's north of 35 billion in assets under management. We have the private credit endeavor that I mentioned earlier. And so we've built a lot over the last couple of years. And for us, we just want to keep growing. We want to add more investment capabilities and distribution and operations capabilities over time as we grow further in these areas. We want to grow alongside our clients. So for the firm, growing the US-based asset management business is one of the top 3 priorities globally. So the firm wants to further increase its fee-based revenues and earnings, and we happen to be in the largest market that has a lot of growth opportunities. So you should expect a lot more growth from us, both organically as well as inorganically.
Well, I'm going to call that a high note. I think we can end on a high note there. So, Robert, it was good talking to you. We can do this again, and appreciate you talking a little bit about what you guys are doing and sort of what the future looks like. So, thank you.
I appreciate it, Tony. Thank you so much. Great seeing you.